But basically right now, there's just not 10 million people that are willing to pay fees to do an on-chain Bitcoin transaction. But I think in 10 years, 15 years, especially when you have almost no new Bitcoin being created, but what I will expect to be significantly more demand for Bitcoin, I think there's a lot more overall fee pressure going to happen. Now, if that doesn't happen, that's a problem, right? That just shows that for some reason the technology was not interesting enough to people. It didn't solve enough problems, basically, that their demand for money was either met elsewhere, or they're just not really interested in kind of having different monies.
In this episode, our guest is Lyn Alden, who's the founder of Lyn Alden Investment Strategy. Lyn's focuses on value investing with a global macro overlay, including currency differentials, shifts in monetary policy, and equity valuations. As Bitcoin attempts to put behind the effects of last year's bear market, the maiden crypto is recording a positive shift in its on-chain activities. Before going further in this video, make sure to hit the subscribe button for more recent updates about digital world. Bitcoin's current demand for inscription transactions, which stands at 1.14, has pushed the asset's transaction count momentum to hit the highest level since January 2021, data by crypto analysis platform Glassnode indicates. The rapid ascent in transaction count reflects a significant increase in the network activity as demand for on-chain transactions begins to return. We attribute this correlation break to reflect a continued mainstream disinterest in crypto products as we return to the fringes of U.S. capital markets and chart our own narratives forward with hopefully more uncorrelated alpha. The most popular narrative since late 2022 is that Bitcoin will repeat history by rallying sharply in the months leading up to its fourth mining reward halving due sometime in March 2024. Reward halving refers to a programmed code that reduces the pace of Bitcoin's supply expansion by 50% every 4 years.
Liquidity is not the only measure that affects asset prices, but certainly in the near term. Let's say a typical equity, right? How it performs over 5 years will largely depend on its fundamentals, but how it performs quarter by quarter will largely depend on liquidity and sentiment. And the same is true for macro assets, gold, Bitcoin, certainly other cryptos as well. And so these things are going to bounce around in large part based on liquidity. And that that like a combined domestic liquidity indicator is a pretty good one. And there's three main components. And so we can kind of, you know, outline what's going to happen with all three of them, right? So the Fed balance sheet is anticipated to keep going down for now. That's basically the Fed's intention to keep reducing their balance sheet, which is negative for liquidity, right? So that's kind of the background direction. Then you have the Treasury General Account. That's basically the Treasury's cash account with the Fed. And this one is inverse, where when it draws down, that's actually good for liquidity. That's pushing money out into the system. Whereas when it increases, it's bad for liquidity because basically it's sucking money out of the system and then just holding it there in this void that's not actually flowing into anything. And the Treasury targets to have around $500 billion just sitting in its cash account. But one of the things that happens during debt ceiling impasses, if it goes all the way to the end, is that one of the things they do when they can't issue more debt is they can draw down their cash account to keep paying their bills until they're able to issue more debt. And so, ironically, in the lead up to a debt ceiling, that could be positive for liquidity because that all that cash is kind of going out into the economy and it's not being refilled. And so actually since, basically quarter four, that has kind of been happening. It's been offsetting some of the Fed's quantitative tightening. So that's been pretty
The
neutral.
U.S. stock market, as measured by the S&P 500 index, appears to be exiting the best era for growth in earnings per share in decades as sources of liquidity have dried up, according to research from Bank of America. Bitcoin's performance following a cross has traditionally been strong, with the average 7- and 30-day returns of 3.8% and 8.3%, respectively. At the start of 2023, the Bitcoin price had dropped by 65%. The drop has led many to believe it was inextricably linked to the performance of growth stocks and highly susceptible to rising interest rates. However, only 2 months later, with central bankers still raising rates to manage inflation, Bitcoin has proven surprisingly resilient. According to Bloomberg's figures, the 40-day correlation between Bitcoin and the S&P 500 index has dropped below 0.3, a level not seen since 2021, significantly lower than a correlation of 1, which would signify an exact parallel between the two assets.
When I look at Bitcoin spaces or when I look at crypto spaces, which are increasingly kind of two separate spaces with some degree of overlap, um, basically the Bitcoin people are generally in pretty good spirits. I mean, I was at Pacific Bitcoin, for example, while FTX was happening, and so the Bitcoin price was nuking, the whole industry was nuking. People were like celebrating and laughing about it, and just kind of just kind of rolling with it. Um, Obviously there's a lot of development happening in the space. People often talk about lack of Bitcoin development, but of course that's mostly base layer focus. There's actually quite a bit of ecosystem development, basically making Bitcoin easier, more accessible, faster, more expressive, things like that on various parts of the ecosystem. As for crypto, I mean, this week was big. I mean, the past couple weeks, there have been a number of people warning about increasing levels of banking system cutting off various crypto entities. And then we've kind of seen the hammer come down on custodial crypto staking from the SEC, basically kind of looking at that as like an investment contract that is subject to regulations. I think this has been rather telegraphed since the FTX debacle. That really kind of lit a fire under regulators, gave them a lot more, uh, kind of just coverage to go after certain things. We've also seen a shift in the head of the Commodities Futures Trading Commission. He used to kind of talk about Ethereum being a commodity like Bitcoin. He walked those back in November, those statements back, and kind of would say, okay, Bitcoin's a commodity. We'll see about everything else. We'll leave that to the SEC, which kind of, we kind of know Gary Gensler's view on that whole thing, where Bitcoin, maybe a couple other proof of work coins are kind of commodities in his view, while everything else is at risk of being labeled a security. So I do think we're kind of seeing a shift away from some of these kind of centralized custodians, and I think.
The importance of the $25,000 resistance level was expanded upon in the latest Ahead of the Curve newsletter from Arcane Research, which noted that Bitcoin is trading at its range highs from the trading range that appeared after the 3AC collapse during last year's summer. Data from CryptoCompare shows the Bitcoin Volatility Index BVIN, which measures the implied or expected volatility over the next 30 days, has remained flat of late near the lower end of its 3-month range of 60 to 100. Implied volatility is often equated with a degree of uncertainty or anxiety in the market. Net position metrics show that investors are sending Bitcoin to exchanges and removing Ether from them. The moves imply bearish sentiment for Bitcoin and bullishness for Ether, a departure from their more typical correlated paths. The difference between Bitcoin and Ether in exchange net position has not extended to the derivative space. Funding rates for both Bitcoin and Ether remain positive, indicating that long position traders are willing to compensate short position traders to maintain their bullish stance.
So the Fed has been decelerating their rate hikes, but they're still doing quantitative tightening at their prior pace. And we have seen disinflation in a number of inflation measures. Some of them rolled over earlier than others, but now there's a broad enough rolling over that Powell has been basically a little bit more confident in his assertions around inflation heading down, while still reiterating that they want to remain tight for longer. This, I think, ties into some of the prior issues I said before, where they're kind of, he's actually cited the 1970s and Volcker a number of times, which is kind of concerning because it's more like 1940s inflation, and he's not really citing that period. It kind of, I think, shows somewhat of maybe a recency bias in that regard, basically around kind of the sources of money creation. The Fed also, when they were talking about inflation being transitory or not being too concerned about inflation prior to this all happening, I also think they're showing a misunderstanding of money creation, which is kind of concerning from the biggest central bank in the world. It's not exactly what you want to see. So my overall view is that he's getting a little bit less hawkish, but he's still reiterating that they're going to stay tighter for longer. And I think they're essentially going to try to stay somewhat tight until they break something, right? Until you have kind of like illiquidity in the treasury market, or you have outright recession. I think they're probably going to stay somewhat tight. Now that is kind of complicated because if you look out long enough, that can actually be inflationary. If you have high interest rates on very high public debt levels, and you keep running deficits anyway, that actually pours more and money into the economy. Basically, the federal deficit is a surplus for the private sector, which sounds good unless it's money creation. It's inflationary over the long arc of time, but it does spell kind of risks. I think kind of for the rest of this year. I do think that the market is. I think I'm not betting on a soft landing. Let's put it like that. I think either you're going to get kind of inflationary breakout or you're going to get a recession that temporarily quells inflation. And that seems to be the way that most economic indicators are pointing to by either the end of this year or early next year.
According to Lyn Alden, 2023 is much more likely to be a year of easing financial conditions than of tightening financial conditions. That's because inflation seems to be rapidly falling, as acknowledged by the Fed this week. The Fed is approaching the end of its tightening cycle and may even be cutting rates by the end of the year to support a U.S. economy that could soon fall into recession. On the other hand, hawkish Federal Reserve minutes and statements suggesting higher interest rates from the Fed officials also favor the U.S. dollar's demand. Markets were previously certain the Fed would hike its benchmark Fed funds rate just 25 basis points in March, but are now showing a 20% probability of a 50 basis point move. The yield on the 2-year Treasury note has increased by more than 50 basis points to 4.64% in February. The dollar index, which tracks the greenback's value against major fiat currencies, has bounced from 102.00 to 104.00 as international money flows take advantage of higher yields. The risk of a break higher in the economy with higher prices is a much bigger risk than recession concerns at this juncture. What are your thoughts on Lyn Alden's discussion about performance of Bitcoin and other cryptocurrencies in 2023? Do you expect digital assets to perform better in long term? Let us know in the comments section below. If you like our content, give this video a big thumbs up and do subscribe to our channel.